Imagine this for a moment. The economy crashes. Stock markets bleed red. News anchors use words like panic and uncertainty. Ordinary people lose jobs, savings shrink, and businesses shut their doors. But somewhere else, quietly, calmly, someone is smiling. Not because they caused the crash, but because they were prepared for it. Every major economic collapse in history has one thing in common. While millions lose, a small group always wins. And today, we're exposing the middlemen who profit from every economic crash. The hidden layer most people never notice until it's too late. Crashes don't look dramatic at first. There's no explosion, no sirens, just numbers moving on screens. Interest rates shift, credit tightens, asset prices fall, and right in the middle of all this chaos, there are intermediaries, brokers, dealers, funds, institutions, and advisors who don't create wealth, don't produce goods, don't innovate, but still walk away richer after every collapse. This isn't a conspiracy theory. It's how modern financial systems are designed. Most people think economic crashes are random or unavoidable. Some blame governments, others blame banks. But very few ask a deeper question. Who benefits from instability itself? Because if crashes keep repeating and the same players keep winning, then maybe the system rewards collapse more than stability. Before we go deeper, if you want more calm, clear breakdowns of how economies silently break down and who really controls the outcomes, make sure you like this video and subscribe to the channel. This is Silent Collapse, and here we talk about the stories happening behind the headlines, the ones that quietly shape your future. Let's start with the most obvious middlemen. Financial brokers. During boom times, they earn commissions by pushing trades. During crashes, trading volume explodes. Fear makes people act. They sell in panic, rebalance portfolios, hedge risks. Every click, every transaction, every adjustment generates fees. Brokers don't care if the market goes up or down. They care that it moves. Volatility is their oxygen. A calm market is bad business. A crashing market is a gold mine. Then come the investment banks. When companies are strong, banks help them expand. But when economies collapse, banks shift roles. They advise on bankruptcies, restructurings, fire sales, and emergency funding. Assets get sold cheap. Debt gets repackaged. Entire companies change hands. The same bank that helped a firm grow during good times now earns millions dismantling it during bad times. They sit perfectly in the middle, collecting fees on both sides of the cycle. Next are the debt traders. When a country or company struggles, its debt gets downgraded. Prices fall. Everyone else panics and sells. But specialized funds step in. They buy this toxic debt at massive discounts. These funds don't want stability. They want distress. Because later, when recovery comes, or when legal pressure forces repayment, those same debts pay out huge returns. In some cases, these funds even block restructurings just to squeeze more money out of already broken economies. Now let's talk about rating agencies. Officially, they just provide opinions. They don't cause crashes, they say, but their timing matters. A single downgrade can trigger forced selling by pension funds and institutions. Capital flees overnight. Currencies collapse. And who benefits? The middlemen who positioned themselves in advance. Traders who shorted bonds. Funds that bought insurance against default. Consultants who suddenly get hired to manage the crisis. The rating itself doesn't move money. The reaction to it does, and the middle layer is always ready. Another powerful group sits in the shadows. Derivatives dealers. During stable times, derivatives seem boring, but during crashes, they become weapons. Credit default swaps, options, and futures explode in demand. These instruments are supposed to reduce risk. In reality, they transfer it. Someone pays premiums, someone else collects them, and the dealers in the middle earn fees regardless of who wins. In some crashes, the cost of insuring debt skyrockets overnight. Fear becomes a product, and middlemen sell it at a premium. Think about this. When you insure your house and nothing happens, the insurance company wins. When something happens, they still try to limit payouts. In financial markets, derivatives work the same way, except the scale is global. Trillions move quietly, while headlines distract the public with surface-level drama. Now let's shift to asset managers. During economic downturns, retail investors panic. They pull money out at the worst possible time. Large funds, however, do the opposite. They accumulate. They buy stocks, real estate, and bonds at discounted prices. They tell their clients they're long-term focused, but the real edge comes from access. Access to cheap capital, access to policymakers, access to inside expectations. They don't predict crashes perfectly. They simply survive them better than everyone else, and surviving is enough. Because every collapse reshuffles ownership. Homes, land, companies, and resources don't disappear. They change hands, and the middlemen control that transfer. There's also a less discussed group. Crisis consultants. Every crash creates confusion. Governments panic. Corporations freeze. Suddenly, consultants appear with models, forecasts, and emergency plans. They charge massive fees to explain what already happened and recommend what should have been done earlier. By the time their reports are delivered, the damage is already locked in, but the invoices are paid. One of the most dangerous illusions in modern economics is that markets are neutral, that they reward intelligence and punish mistakes. In reality, markets reward positioning. And middlemen are always positioned. They don't need to be right about the future. They just need to be necessary in the present. This is why crashes feel unfair. Because they are. Not in a dramatic sense, but in a structural one. The system doesn't collapse equally for everyone. It compresses losses at the bottom and distributes opportunities at the top. You might ask, is this intentional? Not always. Many of these systems evolved over decades. Layer by layer, regulation by regulation, each layer added a new intermediary to reduce risk or increase efficiency. But every intermediary takes a cut, and during crises, those cuts grow larger. History proves this pattern again and again. The Great Depression, the oil crisis, the Asian financial crisis, the 2008 collapse, the pandemic shock, different causes, same outcome. Wealth consolidates upward. Middlemen expand influence. Public trust erodes. And here's the uncomfortable part. Most people only notice the collapse after it's already happened. By then, the middlemen have already adjusted. They moved capital, hedged exposure, locked in fees. The pain you feel is delayed. Their profit is immediate. This doesn't mean crashes are fake, or that suffering isn't real. It means the system is asymmetric. Losses are socialized, gains are privatized, and the middle layer acts as the filter through which value flows. At Silent Collapse, we don't tell you this to scare you. We tell you this to sharpen your awareness, because once you see the pattern, you stop blaming random events and start asking better questions. Who benefits from fear? Who profits from complexity? Who gets paid no matter what happens? The truth is, most people can't escape this system completely, but understanding it changes how you react. Panic is expensive, patience is underrated, and blind trust in institutions is dangerous. As we near the end, I want you to think about this. The next time headlines scream about a crash, don't just ask how bad it is. Ask who's quietly preparing to profit from it. Ask which middlemen are suddenly very busy, because where there's chaos, there's always someone charging a fee to manage it. If this breakdown helped you see the system differently, share this video with someone who still thinks crashes are just bad luck. And drop a comment below. Do you think economic collapses are accidental, or is the system quietly designed this way? Your thoughts matter, and your engagement helps this channel grow. This is Silent Collapse, and sometimes the scariest part of an economic crash isn't the fall itself. It's realizing how many people were waiting for it. And this is why awareness is power. Not prediction, not insider information, awareness. Because when you understand how the middle layer operates, you stop reacting emotionally to headlines. You realize crashes are not sudden accidents. They are processes. Slow at first, invisible to most, obvious only when it's too late. By the time panic reaches the public, the middlemen are already positioned. They've adjusted exposure, they've hedged downside, they've secured upside. This is why the loudest voices during a crisis are never the smartest ones. They are the most afraid ones. Calm never trends. Fear always does. Media plays its role here too. Not intentionally malicious, but structurally aligned. Panic increases clicks. Clicks increase attention. Attention accelerates movement. And movement is exactly what the middlemen need. Remember, stillness hurts them, volatility feeds them, stability starves them. So every breaking news alert, every red ticker, every urgent expert panel serves a purpose. It pushes people to act quickly, and fast action almost always benefits the intermediary. This is also why long-term thinkers are rare, because patience doesn't feel productive. Doing nothing feels irresponsible. But in crashes, inaction is often the most expensive thing for middlemen. Think about how many times you've been told to do something during uncertainty. Rebalance now, exit now, protect now, adjust now. Each of those actions sounds rational. Each one creates fees. Each one transfers value from the uncertain to the prepared. And the prepared are rarely the loudest. They don't post predictions. They don't scream warnings. They quietly wait for price, not opinion. This doesn't mean you should ignore risk. It means you should question urgency. Ask why now. Ask who benefits from speed. Ask who profits from complexity. Because complexity is another product middlemen sell. The more confusing the system feels, the more necessary they appear. Simple systems reduce dependency. Complex systems increase it. That's why financial language is deliberately dense. Acronyms, models, frameworks, all designed to make you feel unqualified to decide on your own. Once you feel unqualified, you outsource judgment, and when judgment is outsourced, control follows. Middlemen don't need authority, they just need permission. This pattern isn't limited to finance. It exists in policy, regulation, even crisis management. Wherever fear meets complexity, intermediaries thrive. And every collapse reinforces this structure. Because after each crisis, instead of simplifying systems, we add layers. More rules, more safeguards, more middlemen. Each layer promises safety. Each layer extracts value. And during the next crash, all layers activate at once. So the real lesson isn't how to predict the next collapse. It's how to recognize the incentives before it happens. Incentives never lie. Narratives often do. At Silent Collapse, this is what we focus on. Not dates, not doomsday claims, but structures, incentives, patterns that repeat quietly. Because once you see the machinery, the noise loses power. Fear becomes less contagious, and urgency starts to feel suspicious instead of convincing. Crashes will continue. That's inevitable. But being mentally unprepared is optional, and understanding the role of middlemen is the first step out of blind panic. The system may not be fair, but it is predictable. And predictability is leverage, even for those without power.